Welcome to DWS Market Outlook. Currently, we do observe signs of a change in the market narrative. Back in March, the turmoil in the banking sector and the resulting tightening of financial conditions caused markets to assume that the inflation issue had more or less been solved. According to this perception, inflation rates, while still too high, seemed to be on the right track. While the economy, although not looking great, is not doing too badly either. In addition, there was the hope that soon after the last rate hike, central banks would start to cut rates again. All this, taken together with the emerging revolution brought about by artificial intelligence, fueled great expectations for future profitability. Recently, one could observe a certain complacency in the markets. For example, the VIX volatility index fell to its lowest level since January 2020. But this friendly scenario is now being challenged from several sides. For one, uncomfortably high inflation rates were reported from the UK for May. The decline in headline inflation stopped at an annual rate of 8.7%, which of course remains far too high. And even worse, core inflation continued to rise, reaching a multi-decade high of 7.1%. That in turn prompted the Bank of England to step up the pace of interest rate hikes again to 50 basis points, having previously slowed down to 25 basis point steps. In a shock reaction, markets pushed up their expectations for the UK policy rate by the end of the year to over 6%. Back in May, these expectations stood below 5%. From the Eurozone in turn, we got a series of surprisingly weak economic indicators. Inflation concerns, particularly with regard to core inflation, are still far from being overcome in the Eurozone as well. Taken together, it may well mean that the markets have to deal with high inflation, rising interest rates, and at the same time a weakening economy for longer than they had hoped. That's it for today. Thanks for watching and goodbye.